Professor Goldreich is a professor of finance and the academic area coordinator for the finance area. Prior to joining Rotman, David was a member of the finance faculty at the London Business School. His research addresses a variety of topics, including treasury auctions, bond liquidity, and most notably, the book building method of IPOs. His research is published in both finance and economics journals. David teaches corporate finance and capital markets in the MBA and undergraduate programs. He has received numerous teaching awards at Rotman London Business School and Carnegie Mellon University. So without further ado, I will pass it over to Professor Goldreich, and I'll stop sharing my screen so you can take over.
Thank you. Thank you very much for having me here. So let's see if I can share my screen. So hi everybody. I'm glad that you can all be here. As you know, I appreciate the kind introduction. I'm David Goldreich. I'm a professor at the Rotman School, which is part of the University of Toronto, and my topic today is financial markets. What are bond and stock markets? You know, why we have them, why they're important. And I will I will warn you that the problem with understanding financial markets is often that there's just so much jargon. People who deal in financial markets, they always talk fast and they always use lots of jargon, lots of language that is specialized language. But the truth of the matter is that underlying it, the concepts are not as difficult as they would have you believe. And what I'd like to do is try to bring it down to the basics and try to understand what's really going on, so that you'll realize that it's not as complicated as people would make you think. So what I do is I teach this course, a financial markets class at U of T, at the University of Toronto. And I'm going to stop sharing for right now so I can talk to you a little bit more directly. And whenever I teach this course, I always start the class. Whenever I talk about financial markets, I always start the class with a little gimmick that I do. What I do is I come into class and I've got my students sitting in front of me, and I always say, okay, financial markets. It's got something to do with money, right? And I think everybody agrees that it has something to do with money. So I say, okay, so for my little gimmick, I need to borrow $20. And I ask my students that I can borrow $20. And there's always some student who's kind enough to lend me $20. This is a Canadian $20 bill with a picture of the late Queen on it, right? And they lend me $20. So, let's call these students who lent me the money, let's call them Adam, right? I'll choose their name. Adam lends me $20. I say, thank you very much. But what I do is then the next thing I do is I say, okay, I want to make this a little bit, make it legit. I don't want them to feel like I'm going to rip them off. So what I've done is I've prepared a piece of paper before class, and the piece of paper looks like this. It says, I owe you $20, signed by, that's my name, David Goldreich. And I even put my signature on it to make sure that everybody make sure it's completely legal. And I hand this piece of paper to Adam. And I say, this piece of paper is documentation of the loan that you lent me $20. Then the next thing I do is, again, go into the idea that there's a lot of jargon in this here. It's like, this piece of paper has a name. What do you call this piece of paper? And people give me lots of different answers about what this piece of paper is. Some people say it's an IOU. Yep, it's an IOU. It's a promissory note. Yep, that's another name for it. But what I call this piece of paper in class is a bond. This is what a bond is. You've heard of stocks and bonds, right? And what a bond is, we'll get to stocks later, but what a bond is simply a piece of paper that says, I owe you $20. And when Adam has this piece of paper, you can think of it as he bought a bond. He bought a bond, and a bond is a piece of paper that simply says that somebody whose name is on the bottom has to give them $20. Now, of course, in the real world, a bond will have a lot more legal language on it. For example, one thing that's missing on this is when am I going to pay him back his $20? Am I going to pay it back at the end of this lecture? Or some bonds are long-term bonds. Am I going to pay it back from him a year from now, or 10 years from now, or 30 years from now? That needs to be specified, as well as all sorts of other legal stuff has to be specified. But the point I'm trying to teach you is that a bond, although it sounds like a fancy financial security, is simply an IOU. Now, again, in the real world, it doesn't usually say, a bond usually doesn't say I owe you $20 signed by David Goldreich. It's more likely to say I owe you $20 million signed by Bell Canada. I owe you $200 million signed by AT&T. I owe you $2 billion signed by the government of Canada, the United States Treasury, right? That's what a bond is, but it's basically a loan where the people who bought the bond, right? The people who bought the bond, in this case was this fellow Adam, who bought the bond from me, is lending money to somebody who needs the money. And the reason why people need the money, why does Bell Canada or AT&T need the money? Because they need the money is because they have business ideas and they want to, for example, build a new factory. They need to expand their business. So the idea is that somebody in some investor takes money, right? It's not going to be $20 in the real world. It's going to be a larger sum. Takes $1,000 or $10,000, whatever, buys a bond from Bell Canada or AT&T or whoever. The company's going to take that money. The government's going to take that money and they're going to build factories with it. They're going to hire new people. They're going to expand their business with it. And in exchange for that, when at some future date specified on the piece of paper, you're going to get the $20. So that's all that a bond is, right? And again, the idea of what I'm trying to do is demystify and say it's not as complicated as people think. That's all that a bond is. Now, of course, there's going to be more to it than that. Here's the problem. The problem is, and this is, again, you can sort of imagine this in my classroom, that I got this student, Adam, who lent me $20, and I give him a piece of paper in exchange for that. The problem is that, sometime in the middle of class, Adam is thinking to himself, I want to get out of here. I want to sneak out of class. At the break, I'm just going to sneak out of class and skip the second half of class, which, by the way, when you guys do go to university, it's a very bad thing to do. Please don't do that. Please stick around for the entire class. But Adam wants out of class. What does he do? The problem is I've got his $20. So what Adam can do is he can take this piece of paper, lean over to the person sitting next to him. Let's call her Betty, and say, hey, Betty, right? I want to get out of class. You got $20. I'll give you this piece of paper in exchange for $20. And Betty will say, okay, sure. And she'll give $20 to Adam. So Adam can leave class and she's got the piece of paper. And then a little while later, Betty wants to sneak out of class. So she'll go to next person, right? Charlie, right? And say, hey, Charlie, you got $20? And Charlie will give her $20 and pass along the paper to him. We'll then go on and give it on to, we'll then later on trade it to Daniel, to Edward, to Francine, and so forth. And the piece of paper will be moving around the class, and each person will be buying the piece of paper off of the previous person. And then at the very end of class, Zachary comes up to me and says, hey, can I get my $20 back? And I will give him his $20 in exchange for the piece of paper. This is called the bond market. That's what all a market is, right? A market is where people can buy and sell pieces of paper like this, right? Or bonds. People can buy and sell pieces of paper like this from one to the other. And what that does is it allows people, someone who basically made an investment in Bell Canada or AT&T or in me, that when they want their money back, I tell the stories if they wanted to get out of class, but they need the money because they want to pay tuition for something. They need the money they saved up to buy a house. Now they want to buy a house, right? Whatever they need the money for, they can always get their money back. They don't have to wait until class is over, until the bond matures, until the bond is ready to be paid off. They can just sell the piece of paper to somebody else. And that's what a bond market does. A bond market allows people to lend money to the company that builds the factory, but then they can get their money back sooner by selling the bond to somebody, from one person to another. I do want to, some of you may be thinking right now, yeah, but I lend money for a bond. I should be able to get interest on my bond, right? And it's true. And some people, sometimes the bond doesn't really look like this. Sometimes the bond would look like this. They say, I'm lending $20, but I get an extra $1. We call this the coupon or the interest. Let's say there's an extra 5%. Let's say you lend the money to me for 1 year, and at the end of the 1 year, I'm going to give you back $21. So that's fine. I mean, that's often going to be the case. But you got to remember, when people are buying and selling this piece of paper, Albert's selling it to Betty, who's selling it or Adam sells it to Betty, who sells it to Charlie, who sells it to Daniel, whoever those people were, right? When they're buying and selling these pieces of paper, they can buy and sell it at any price. And the price that they're going to pay depends on a bunch of different things. For example, am I likely to pay the money back? Right? Perhaps I won't pay the money back. Perhaps they lend money to a company and the company goes bankrupt and they don't get paid back. So that's going to affect the price. If people think that the company is going to go bankrupt, then people will buy and sell this piece of paper for a very low price. If people think that the company is a good company, a profitable company that's going to pay back for sure, then the price will be high. It's also going to be related to interest rates. We don't have enough time to get into interest rates, but the idea is that if interest rates are very high, as you may know, interest rates are higher now than they were previously. When interest rates are higher, then anybody lending money is going to say, I'm only going to lend you money if I can get a return that's at least equal to what I could get by putting my money in the bank. That's also going to affect it. So let me go back to sharing my slides here for a moment. Where was it? Right? And the point that I was trying to make, the point that I was trying to make is that bond is simply an IOU. And so when you buy a bond, you're essentially lending money to somebody, right? Either you're lending money to me, I am AT&T or Bell Canada, the company that wants to make build a factory or something like that. And I'm the issuer of the bond, jargon alert, issuer. I'm the issuer of the bond. Basically means that I'm borrowing money, right? So you can either say that you bought a bond or you can say you lent money, means the same thing. I issued a bond or I borrowed money, same thing. And when you look at this bond, right, there are going to be some features of the bond. It's going to be, what's the face value of the bond? It's going to say, I owe you $20, right? It's going to be $20, it's going to say, or $200 million. That's going to matter. The coupon is, oh, and I give you an extra $1 as interest. Sometimes it has that, sometimes it has more coupons, sometimes it has less coupons. The maturity means when the bond is going to be paid off and so forth. There's lots of features on the bonds, and those are all going to affect how we think about bonds. And when you think about the value of the bond in the bond market, people are buying and selling bonds, and what's the fair price for that bond? It's going to depend on those features. Obviously, if it says I'm going to pay you $20 million, the bond is worth more than if it says I'm going to pay you $20. It depends on credit risk. Credit risk means, am I really going to pay you back, or am I going to go bankrupt, right? What's the probability of me going bankrupt? Am I highly indebted? Am I a company that's in really bad financial straits? That's different than a company that is making lots of profit. And what are interest rates, right? In the economy, are interest rates high? Then investors are going to say, I'm only going to buy this bond if it's going to give me a high return. So there's some of those things that we talk that will affect the value of a bond. Here is an actual bond. This is an actual bond that was issued by the United States government back in 1977 for 30 years. That's a picture of President Teddy Roosevelt at the top. And you can see that this is a bond. It has a face value of $1 million. It's as if the government says, can we please borrow $1 million? It has a coupon rate. You can see it in the red there, right next to President Roosevelt, of 7 5/8%. That means like 7.625%. That means the government is saying, can we borrow $1 million? Can we borrow $1 million? And we will give you 76,000 and whatever, 76,000 and change each year as interest for 30 years, from 1977 until 2007, right? That is going to be what you're going to get. So if you bought this bond from the US government, you'd think I lend $1 million to the US government. Every single year they give me $76,000 because that's the coupon rate, because that's like the interest that I earn on it. And then at the end, after 30 years, at the end, I get my $76,000 and I get my $1 million as well. That's what I'm getting for the bond. I will tell you, this particular bond, when they sold the bond originally and the government was trying to sell the bond, they actually had an auction. Think about like auctioning art. They say, hey, anybody want to buy this bond? What's the most you'll pay? Right? People paid, it was large financial institutions paid actually a little bit less than $1 million for this bond. They paid $990,000 for this bond is what they actually paid for. And the reason why they paid less than $1 million is because at that time in 1977, 7.625%, 7.625% wasn't quite enough, right? It wasn't a fair interest rate. They probably should have given a higher interest rate. So people bought it at a slightly lower price because they thought it was not as a good enough interest rate. So effectively, they got a better return. This is what this is what a bond is. I'm going to stop sharing for a moment again and come back here. So if I need money from you, I say, hey, lend me $20 so I can build a factory, and I'm going to give you back $20, or maybe I'll give you back $21 in a bond. But the truth is, there's another way I could have done it. I could have said, hey, can you lend me some money? I need some money. But what I have is, instead of telling you how much I'm going to give you back, I actually have a business. My company is called Toronto Enterprises, based here at the University of Toronto, obviously fictional, right? And instead of saying that I'm going to give you $20, I'm going to say, I've got this business. You can look into it. Let's look at my financial statements. Let's learn what my business is. And whatever I earn in the future, you get 1% of the profits. You get 1% of the profits of Toronto Enterprises. And what I'm trying to point out to you is that's kind of similar to saying I'm going to give you $20. In the case where I say I'm going to give you $20, it's going to be $20. When I say I'm going to give you 1% of my profits, it's kind of, I'm going to give you some money, but it's uncertain how much I'm going to give you money. If my business does well, I'll give you a lot of money. If my business does badly, then I'll give you less money, depending on how well my business. Now, certainly, even this, I owe you $20. If my business is terrible, then I go bankrupt and you don't get your $20. But here, there's much more uncertainty about what you're going to get. But what I'm trying to point out is conceptually they're similar. This second piece of paper that I have up here that says that if you give me money now, a certain amount of money, I'll give you a percentage of my profits. I don't know if you guys have figured out what it is, but this is what a share of stock is. A share of stock means you're basically a partner in the company. Whenever the company earns money, a portion of it is yours. A portion of it is yours. Here, let me share my screen again. That was a bond, right? That was a bond. This is a share of stock, right? This was a share of Walt Disney. That if I was Walt Disney and I sold stock to you, and instead of giving you a bond that promises you a fixed amount of money, it says, well, whatever Walt Disney makes, you're going to get a slice of that. So my point is really that stocks and bonds have these similarities. And when people buy and sell shares of stock as opposed to bonds, when Albert sells it to Betty, who sells it to Charlie, who sells it to Daniel, who sells it to Edward, right? What people are always going to be thinking about is this company going to make a lot of profit in the future? Whoever owns this piece of paper is entitled to 1% of the profit, or it's not going to be 1%, it's going to be a thinner slice than that. But whoever is entitled to have a piece of paper is going to get a slice of the future profits. So if we think that the future profits are going to be high, then the value of the stock is going to be high. If we hear news that says, this company is not doing so well and it's not going to make a lot of profit, then the price will be lower. And every single day, the price goes up and goes down based on what people think it's going to be. But in both cases, whether it's stocks or bonds, this is a way for companies to raise capital. Capital is a fancy word for money, so that they can build their factories. And then after they go and they sell the stuff that they're producing, then they have to either give money to the bondholders based on whatever that fixed amount is that they promised bondholders, or they have to give money to stockholders, pay them dividends, or reinvest it on their behalf. And that's what stocks and bonds are. But the other thing I want to talk to you about is why we have financial markets, right? Financial markets are basically, you've got some people who have extra money, right? Investors, you and me, I get my paycheck at the end of the month, right? And there are people who need money, called companies, businesses who needed to build their factories, right? So and what this is it's a matching, so that people who have extra money can allow people who need the money to use that money. I mean, why do we have any markets? Why do we have fruit markets? Why do we have fruit markets? We have fruit markets because there's some people who have lots of fruit. Those people are called farmers. And some people who would like to eat fruit. Those are people who want to eat fruit. And so we have a fruit market, right? We have a fruit market where the farmers sell the fruit to people. Or we have an intermediary called a supermarket who buys the fruit from the farmer and sells the fruit to people. Same thing's going on here. You get people who have extra money, they deposit it into a bank, and then the bank lends it to a company, or the people just buy a bond from a company, and that way the money can get used in order to build businesses. But that really leads me to my final point here, which is, but why? Why do we need financial markets? And why are financial markets so important for the economy? Well, how do they help us have a better world, where we have a more prosperous world, where we have lots of goods and services? So I want you to just sort of think back and think back about what business was like, say, if you didn't have financial markets, back in the olden days before you had stock markets and like that. Well, people had businesses. You could have a small business. You say, let's say I know how, I'm a bakery, and somebody taught me how to bake. So what I do is I have whatever money I have, I buy an oven, perhaps I rent a storefront or something like that, and I start selling baked goods. And people come and they buy goods, bakery stuff for me, and I sell them bakery stuff. And that works perfectly fine. But what happens about how do you get large businesses? An airline, an auto manufacturer, right? In order to get an airline, you need somebody who has so much money that they can buy a whole bunch of airplanes and fly the airplanes, run the business, and do that, and know how to run have so much money and know how to run an airline. That's not going to happen. So what instead we say is, in order to run an airline, what you actually need is you need a lot of people to invest in the airline. It's so expensive to build an airline. So that's what financial markets do. They allow you to sort of borrow money by selling bonds, selling stock, and raising capital money, raising money from lots of people, put together this big amount of money. And then I don't even have to run the airline. I just hire somebody who does know how to run the airline, right? It doesn't have to be the same person. The person who runs the airline is not necessarily the owner of the airline in any respect, right? You hire somebody who knows how to run an airline, and you hire pilots, and they run the airline on behalf of many, many, many small investors. And each investor might only have a tiny, they may have put in a few $100s into it, a few $1,000s into it, some tiny amount of money, and you're running the airline on behalf of them. And you can't do that unless you have some sort of financial markets. And the financial markets are even better than that, right? Because what financial markets, stock markets, and bond markets do is, just like when Adam lent me $20 and he wanted out, he could sell it to somebody else. If you buy shares in the airline and then you say, I own the airline, I own United Airlines, I own Air Canada, I own British Airways, right? I own a tiny slice of it, right? And then you say, but you know what? Now I need the money in order to buy my house. Then you go back to the financial markets and you sell it and you get your money back. So financial markets make it much easier for companies to raise money to be able to do big things. And at the same time, those investors are willing to buy stocks and bonds, because if they ever need their money, they can go right back and sell it on to somebody else. It adds liquidity is the jargon for that. And that's what allows us to build big businesses. And we could not have big businesses doing these large scale things unless we had financial markets. And that is the end of my story about trying to give you a flavor of what financial markets are, stock markets and bond markets, and how they are important to allow companies to do big things. And they're important for investors to be able to invest their money and get at their money whenever they need it.
Excellent. Thank you so much for that